Hold on, stop the tape. Matt, before we start today's show, I need to tell our listeners something that's probably going to make some people uncomfortable.
Uh-oh, here we go. Should I lawyer up now or
Now, this is a financial product, it's an annuity actually that could protect millions of Americans from their biggest retirement fear, and almost no one's talking about it.
let me guess, it's too complicated or too boring, it doesn't have enough bells and whistles.
Yeah, kind of all the above. It's called a QLAC. Which means Qualified Longevity Annuity Contract. And here's what makes me frustrated. This product solves the number one fear that retirees have, which is outliving their money.
Mhm.
But it requires having a conversation about being 85 years old. And a lot of people, financial advisors, don't really want to have that conversation. Of course, the people talk about them being
Yeah. So we're talking about a marketing problem, not a product problem.
exactly. The product's brilliant. The math's bulletproof, but it doesn't have the sizzle of participate in market gains or unlimited upside potentials. It's really pure insurance. And of course, we all believe insurance is boring. You need it.
Well, then, buckle up, America. You're listening to Plan Life Right with Kevin Ross and Matt Floyd. And today we're talking about the retirement crisis hiding in plain sight. What happens when you're 85 and your money runs out?
All right, so let's dive right in, Matt. Quick question. What's your biggest retirement fear?
Honestly, living to 95 with the bank account of an 80-year-old?
That's it. It's right there is what QLAC solves, okay? QLAC stands for Qualified Longevity Annuity Contract, and it's essentially longevity insurance. You're insuring against the risk of living too long.
All right, so walk me through exactly how this actually works.
All right, so picture this, you're 70 years old, you got $500,000 in your IRA. You're worried about two things, running out of money and getting killed on required minimum distributions that push you into the higher tax
Mhm.
brackets. So here's what you do. You take 125,000 from that IRA and you buy a QLAC that starts paying when you turn 85.
So you don't get any income from that 125,000 for 15 years?
Correct. And that's the magic because the insurance company has 15 years to let that money grow before they start paying you your payout rate. And it's massive. That 125,000 could essentially generate you like $40,000 or more per year for life starting at age 85.
So hold on, $40,000 a year for life from a $125,000 investment. That's like a 32%
Yeah.
annual return.
Yeah. Once it starts, yes. And here's the kicker. While that money's sitting in the QLAC, you don't have to take RMDs on it. So that 125,000 is completely excluded from your required distribution calculations until age 85.
So you're reducing your taxable income for 15 years and setting up guaranteed income for when you're most vulnerable.
Exactly. This is this is tax deferral meets longevity protection. The IRS lets you put up 200,000 in QLACs across all your retirement accounts. Most people use, between 50 and 150 depending on their situation
Mhm. So why isn't every advisor talking about this?
because you know, it requires a conversation that a lot of people don't understand even in the advisor's standpoint. A lot of the marketing companies, they don't really talk about it. Um,
And
the
the clients don't want to talk about it either.
no,
They're like,
because,
hey, let's talk about when you're old as
yeah,
dirt.
yeah.
What? Excuse me?
They're 70, they've retired, they're like, "Oh, man, we're gonna go on all these trips and stuff." And you look at them and you say as a financial advisor, "Hey, let's plan for you at 85. Let's talk about what happens if you outlive your money. Let's talk about healthcare costs tripling, potentially losing your spouse, maybe needing care."
And that's not a fun conversation.
Not at all. It's so much easier to talk about growth, accumulation, participating in market gains. That's exciting.
Right.
Planning for 85 years old. It can be depressing. But you know what's more depressing? Actually being 85 with no plan.
So who specifically needs to be thinking about QLACs?
So here's my list. If you're between 65 and 75 right now, if longevity runs in your family, parents lived into their 90s, if you're in good health, if you have significant IRA or 401k balances, and in the words running out of money, keep you up at night, you need to at least explore whether a QLAC makes sense.
And you're not locking up, you're not putting all of your money into this thing, right?
Never. This may be 15 to 25% of your entire retirement portfolio. The IRS caps it at 200,000 or 25% of your account balance, whichever is less. But what you're doing is you're creating an income floor for your 80s and 90s while keeping the rest of your money invested and accessible.
So it's like having a pension that doesn't start until you really need it.
That's a really good analogy. It's a self-created pension, for your most vulnerable years. Mm.
Okay, I want to dig into this RMD angle because I think this is huge and most people don't understand it. I'm in my 40s. Most of my friends have never even heard of RMDs. So, Kevin, explain how QLACs reduce required minimum distribution.
All right, so let's use some real numbers here. Say you're 73 years old with 800,000 in your traditional IRA. Under current rules, you have to start taking RMDs now at age 73, and the amount is based on your life expectancy. So at 73, you're looking at roughly about a 3.8% distribution requirement.
So, I mean, that's a little over $30,000 that you have to pull out and pay taxes on.
Correct. And whether you need that money or not, Uncle Sam wants his cut. Now, let's say you had put 150,000 into a QLAC. And at age 70, that starts paying at age 70, now starts paying at age 85. That's $150,000 that's completely excluded from your RMD calculation.
So now your RMD is calculated on 650,000 instead of the $800,000 you have total.
Exactly. So instead of a $30,400 RMD, you're looking at 24,700. You just reduced your forced taxable income by almost 6 grand a year.
Yeah, that's a vacation every year.
Yeah.
And for someone in, let's say, a 22 or 24% tax bracket, that is real money.
Yeah, it's like 1,300, 1,400 in tax savings every single year from age 73 to age 85. Over 12 years, that's 15,000 to 70,000 in taxes that you didn't have to pay, and you still get that guaranteed income starting at age 85.
Yeah, and this is huge for the high net worth retirees who don't even need their RMD money. They're just forced to take it because it's a rule on the books.
Absolutely. I work with clients and advisors with clients all the time who say, I don't need this money from my RMDs. It's just pushing me into a higher tax bracket and forcing me to invest in, taxable accounts. So QLAC solves part of that problem while simultaneously creating a longevity protection.
So walk me through an ideal scenario. Who's the perfect QLAC
All
client?
right, so let me paint a picture. We'll meet this guy. We'll name him Richard. He's 72, just retired, has 900,000 in 401k and another 400,000 in taxable brokerage account. So between his Social Security, small pension, he's got income covered for now. His parents both lived into their mid 90s. He's in great health, exercises regularly, and he does this.
Classic longevity risk candidate right there.
Exactly. Richard doesn't need more income right now. What he needs is protection against outliving his money and a way to reduce his RMD that are about to start. So we take the $150,000 from his 401k and we buy a QLAC that's going to kick in at age 85.
And what does that get him?
All right, so based on current rates right now, roughly about $42,000 per year starting at age 85. Those RMDs reduced by about $5,700 per year, saving him about $1,400 in annual taxes. And almost importantly, he gets to sleep better knowing that even if the market crashes, even if if he lives to 100, he's got $42,000 a year guaranteed to cover is increased healthcare cost and living costs.
And he still has the $750,000 in his 401k plus his other assets to live on and enjoy.
Right. So the QLAC it's not replacing his income strategy. It's completing it. It's the safety net for his safety net.
Okay, but I know what people are thinking. What if I die before 85? I just wasted $150,000, didn't I?
Yeah, it's a great question. But most QLACs offer what's called a return of premium death benefit or a cash refund feature. So if Richard dies at 82, his beneficiaries get back their premium he paid minus any payments received or percentage of the value. So, yes, adding that feature reduces your payout rate slightly, maybe from 42 to 38, but it protects your legacy.
So there are ways to structure it that makes sense to people who are worried about premature death.
Absolutely. And here's the thing at some level, you're betting on longevity. That's what insurance is, right?
Mhm.
You're transferring risk. If you die young, the insurance company wins. If you live to 100, you win big. People with strong longevity indicators, that's a bet worth making.
Right. And if your financial advisor isn't planning for a 30-year retirement, you need a new financial advisor.
So we've talked about the tax benefits. Now let's talk about why they matter so much. Because here's the uncomfortable truth about financial advisors, or that most financial advisors won't tell you. There's a longevity crisis that's coming, and most people are completely unprepared for it.
Yeah, break that down for me.
Right. So most people plan like they're going to die at a normal age. But what's normal anymore? A healthy 65-year-old couple today has a 45% chance that at least one of them lives to 95. 20% chance one of them hits age 100.
And those odds are way higher than I thought.
Yeah, they're higher than most people realize. And here's where it gets financially terrifying, okay? The average retirement savings for Americans age 65 to 74 is about 200,000. If you're following the 4% rule, that's $8,000 a year for savings. Add Social Security, maybe you're getting the 35,000 total annually.
That's not a lot of cushion.
Not at all. And it might work if you die at 83. But if you live to 93, you just added 10 years of expenses, healthcare costs that compound, inflation's eating your purchasing power, potential long-term care needs. That extra decade could require an additional 150 to $300,000.
Yeah, which most people don't have. So you're basically signing yourself up for another 10 years of work right at the tail end of your life.
Which most people absolutely don't have. You're right. And this
Yeah.
is where the psychology gets dark. Imagine being 87 years old, watching your account balance drop every year, knowing you might have another decade to live. The anxiety, the fear, the stress of potentially becoming a financial burden to your kids.
Yeah, that's horrifying.
It is, and it's preventable. This is exactly what QLACs solve. Let me give you a real scenario. We'll call this Lady Marie, 68, 400,000 in her IRA, 200 or gets $2,000 a month from Social Security. She's comfortable now,
Mhm.
but she's watched both her grandmother and her mother live into their mid 90s. She's terrified of outliving her money.
So, what did you recommend? That she start smoking or something like
Yeah.
that?
Get some snuff like back in the
Yeah.
day, Tennessee. So what we did, we took 100,000 from her IRA and we bought a QLAC that starts at age 80.
Mhm.
So it's 12 years from now. She'll get about $28,000 a year for life. Now, fast forward to age 87, Marie's original 300,000 has been drawn down to maybe 150. Healthcare costs have increased. She needs help around the house a few hours a week.
But she's got that guaranteed $28,000 coming in.
Exactly. That 28,000 plus Social Security covers her basic needs. The remaining 150,000 is for extras, emergencies, leaving something to her kids. She's not panicking about running out of money because she can't run out. She's got lifetime income.
Yeah, I'd say just that peace of mind alone is worth something.
It's worth everything. I've seen retirees who won't spend money on themselves because they're terrified of depleting their savings. They're miserable at 70 because they're trying to preserve their money for 90-year-old them. A QLAC gives you permission to actually enjoy your early retirement because you're protected late.
Okay, so talk to me about the trade-offs. What are the downsides to QLACs that most people need to
All
understand?
right. Well, there's really three big ones. First is liquidity. Once that money's in a QLAC, it's locked.
Right.
You can't access it for emergencies. So you better have other liquid assets available. This is why you never put more than 25% of your funds in the QLAC.
Yeah, they should
And
call
the
it a
IRS
Q
does
lock.
like, yeah, right.
Let's make it a soft day and
A
call it a Q
QLAC,
lock.
yeah.
What else? What's the second
Second,
one?
inflation risk, okay? Most QLACs pay a fixed amount, 28,000 per year. Sounds great in 2025. But in 2036, after 12 years, or 2037, after 12 years of inflation, it won't buy as much, really. Some contracts offer a cost of living adjustment
Mhm.
riders, usually a 2 to 3%
Yeah, that's
annual
gonna cost you a little
increase. Yeah.
extra.
But that significantly reduces that starting payout, right?
So there's a trade-off really between higher income now versus inflation protection later.
That's right, exactly. And third, mortality risk. If you die before payments begin, you essentially lost that money unless you purchased return of premium protection.
Mhm.
Okay. So you really need to have strong longevity indicators, good health, family history, non smoker, for it to really make sense.
Yeah, so this isn't for someone with serious health issues or lost both of their parents in their early 60s or anything like that.
Right. Correct. If you've got significant health problems or you got a client that's coming in smoking cigarettes, they've got a shortened life expectancy. So QLAC doesn't really make sense. You'd be better off with an immediate income product or keeping that money invested and accessible.
Right.
So,
All right, so I want to zoom out for a second because I think we're talking about something bigger than just QLACs. We're talking about retirement income strategy. Kevin, how do QLACs fit into a comprehensive retirement income plan?
it's a great question. I think retirement income is really about layers, what I call the retirement income ladder. Each decade of retirement has different needs and risk, and you should have different tools solving for each phase of.
So break that down for us.
Okay, so phase one, age 65 to 75. This is your active retirement phase. This is when you're traveling, you're active, you're spending. For this phase, you want liquidity and flexibility.
Right.
This is where you use like fixed annuities or dividend paying stocks,
Mhm.
maybe a MIGA, which is a multi-year guaranteed annuity, um, income that you can access, adjust, and control.
Because your needs might change year to year.
Right. Um, and then you got phase two, which is like 75 to 85. You're
Mhm.
slowing down a bit. Healthcare costs are rising, but you're probably still pretty independent.
Mhm.
This is where fixed indexed annuities with income riders can work well.
Right.
This is where you've got guaranteed income, some growth potential, and predictability.
And then what would you say is phase 3?
That's your age 85 and beyond, the high risk zone. Healthcare costs spike,
Right.
might need care, might be widowed, you got some cognitive decline that could be a factor. This is where a QLAC is absolutely brilliant because it's guaranteed, it's simple, and it can't be outlived.
So you're essentially building a 3-layer income strategy.
Right, and here's the key. Most advisors only plan to, for phase one, maybe phase two. Their setup income for the first 20 years or so of retirement. Cross their fingers if that client either dies by then or has money left over. That's not really planning. Let's call that hoping, right?
Right. So a QLAC is specifically solving for phase 3, the years when you're most financially vulnerable.
Exactly. And when you think about it that way, the downside of locking up that money certainly doesn't seem like a downside anymore. You want that money locked up, guaranteed for your most vulnerable years, right? You don't want 87-year-old you making investment decisions or worrying about market volatility.
And that's actually a really good point. The lack of liquidity is it's a feature, not a bug.
Precisely. Here's another, piece most people don't think about. ULACs are behavioral insurance. They protect you from yourself,
Mhm.
from the temptations to spend too much early, from making bad investment decisions late in life, from cognitive decline affecting those financial decision making.
So walk me through what an ideal comprehensive income plan looks like that includes that QLAC for phase 3.
Okay, so let's use some round numbers here. Client has 600,000 in retirement savings,
Mhm.
gets $30,000 a year from Social Security. Here's what I recommend. You put 100,000 into a QLAC starting at age 85. That's going to generate
Mhm.
$28,000 a year for life. And then you have 200,000 in an indexed annuity with an income rider that starts at age 70, generating about $12,000 a year.
Right.
And then 200,000 in some diversified investments, some ETFs. Um,
Yeah, the kind with the covered calls though.
uh, yeah, something that's going to generate some income, some dividend, um, type ETFs.
Yeah, traditional the things you think about when you
Right.
think about retiring.
And you got 100,000 in, cash and you know, short-term money markets, emergency flexibilities.
So between the Social Security, the annuities, and your investment income, you're looking, if my math is right, about $78,000 per year once everything kicks in.
Right. And more importantly, they've got guaranteed income of $70,000 per year from the Social Security and the annuities that they can never outlive. Right.
Right.
So the investment for portfolio is gravy. Use it for travel, gifts for the kids, the grandkids, unexpected expenses. If it grows, great. If it doesn't, still okay.
That's comprehensive planning.
That's what I'm trying to get to advisors and consumers to understand. A QLAC isn't a standalone
Right.
solution.
You'd never go all in on this.
No, no, nor could you. But it's the one component of a layered income strategy that protects you across your entire retirement lifespan. Okay, so we've talked about what QLECs are, why they matter, and how they fit into comprehensive planning. Now, let's talk about how you actually get your advisor to have this conversation with you.
Yeah, because based on what you're saying, most advisors aren't even bringing this up.
Yeah, correct. Because it's not because they're bad people, it's because it's kind of a difficult conversation that requires some long-term thinking. They'll say, "Well, we'll just put everything into income annuity. Hey, let's stagger this." So, if you're listening and you want to explore whether QLAC makes sense, here are the exact questions to ask.
All right, I'm ready. Let's go ahead and give me that script.
All right. So, question one: can you walk me through what my financial picture looks like at age 85 and beyond? What risks should we be planning for? This forces your advisor to think long term. If they talk about growth and accumulation without addressing late life risk, that's a red flag.
And what should you hear when you ask those
You want to
questions?
hear about healthcare cost increases, inflation impact over 20 plus years, potential for cognitive declines, widowhood, long term care risk. If they can't articulate these risks specifically, they're not thinking comprehensively about your retirement.
So if he says, "We don't worry about that because hopefully you're dead by then," you need to
Uh,
run out of his office
yeah, they're not gonna
immediately.
say that. Never met an advisor say that.
Okay, so what's the next question?
Question two, have you evaluated whether a qualified longevity annuity contract makes sense for my situation? Say those exact words. Watch how they respond. Do they immediately understand what you're asking? Can they explain what a QLAC is without Googling it? Do they engage with the question thoughtfully?
And if they dismiss it altogether?
Ask why. What specifically about my situation makes a QLAC inappropriate? If they can't give you concrete reasons based on your health, your longevity indicators, your tax situations, then they're dismissing it because probably they're unfamiliar, not because it's wrong for you.
And what else?
All right. So, question three: how are you specifically planning for longevity risk if I do live to 95 to 100?
Or beyond?
Yeah. Now, for beyond, this gets really at the heart of the issue.
Right.
If their answer is, well, we'll monitor it and adjust, that's not a plan. You want
That's
to
a wait
hear,
and see.
yeah,
Yeah.
you want to hear some specific strategy. Guaranteed income sources, conservative withdrawal rates, multiple income layers.
Yeah, give me another one.
All right, question four. Can you show me how my required minimum distributions will impact my taxes over the next 15 years, and are there strategies to reduce the tax burden? This opens the door to the RMD discussion and allows them to introduce QLACs as tax planning tool if they understand them.
And then the final question.
Question 5, can you show me 3 different income strategies? One that prioritizes flexibility, one that prioritizes guaranteed income, one that balances both. So this forces them to think in terms of trade-offs and shows you whether they can build comprehensive, multi-layered plan.
Yeah, these are really good questions. People should literally screenshot this section, take notes on your notes app. I mean, commit them to memory, repeat the questions, say them out loud like your
Right.
financial advisor sitting in your car with you right now.
And here's the thing, these are the gotcha questions. These are legitimate planning questions that any competent advisor should be able to answer. If your advisor gets defensive or uncomfortable, that tells you something important about their planning approach.
And if they can't answer these questions well,
Then you need to seriously consider whether you have the right advisor. Look, I'm not saying everyone needs to work with a QLAC specialist, but your advisor should be at least familiar enough with the tools available and be able to explain why they do or don't make sense for you specifically.
all right, Kevin, we've covered a ton of ground today. Before we close out, let go ahead and bring this home for the people. What's the one thing you want everyone listening to understand?
All right, so here it is. The retirement you're planning for at 65 is not your retirement you'll be living at 85. Your energy is going to be different. Your
Mhm.
health will be different. Your expenses will be different. Most critically, your ability to adapt and make complex financial decisions will also be different.
That's sobering.
It should be. Because here's what keeps me up at night. I see 70-year-olds making plans like they're going to stay 70 forever, right? But if you're healthy right now, there's a really good chance you're going to be 90 someday. And at 90-year-old, you deserves the same financial security and dignity that 70-year-old you enjoys today.
And that's what QLACs provide protection for future you.
Exactly. They're not sexy. They don't have upside potential, but they do guarantee that when you're most vulnerable, you'll never you'll never be financially desperate. And I'll tell you, I'd rather have my clients mad at me at 72 for having that uncomfortable conversation than them scared at 87 because we didn't do anything.
So, who needs to take action right now?
I'd say if you're between 65 and 75, if longevity runs in your family, if you're in good health, if you have significant retirement savings, and if the phrase outliving my money causes you anxiety, you need to have this conversation this month, not next year, not eventually. Do it this month
Because,
because the math works better the earlier you start.
right.
QLAC purchased at 70 delivers better rates than one purchased at 75. And more importantly, peace of mind compounded over 15 years is worth its weight in gold.
All right, here's what we need from the Plan Life Right community.
All right, so first, take action immediately. Download our free longevity planning checklist at planliferight.com. It includes everything we discussed today: QLAC evaluation framework, the 5 questions to ask your advisor, and how to assess your longevity risk.
Second, you want to schedule a conversation, not someday, this week. Book 30 minutes with your financial advisor and ask them specifically about QLACs. Use our 5 questions, see how they respond, and email us at, oh, we'll send them to the confessions inbox, confessions at planliferight.com.
Right,
That'll
we can
work.
do that.
We want to know if this conversation's actually happening.
And then third, share this episode. If this opened your eyes, someone you love needs to hear it. Your parents, your siblings, anyone within striking distance of retirement. This is planning that should be standard, but isn't. Help us change that.
Yeah, and finally, subscribe, like, leave some comments. Hit subscribe right now on wherever you're listening. Apple Podcast, Spotify, YouTube. Leave us a review if you feel like this content helped you. If you have questions, drop a comment. We'll get back to you as soon as we can. It genuinely helps, more people find this information when they need it most.
And here's my personal promise. If you email us with specific questions about your situation, we'll respond. We'll point you in the right direction. This matters too much to leave you to chance.
Yeah, next week we're tackling Social Security claiming strategies that could net you over $100,000 in additional lifetime benefits. Trust me, you don't want to miss that one.
And until then, remember this: the financial industry will help you plan for retirement, but it's your job to plan for longevity. There's a difference. Make sure your plan covers both.
Yeah, life's too short to plan it wrong.
So plan life right.